Damian, I don't want to get too technical because I think the whole point of these conversations is to try and make it approachable and, understandable to anyone who wants to listen. But there is a little bit of a kind of geeky nuance that I think we should probably address and cover. So the topic is mutual funds. The topic is the specific investment structures that we actually use for investing client assets. I know it's not glitzy and glamorous, but there's something interesting happening there within client portfolios. A lot of clients, if they're watching this, will realize we've just gone through our semi-annual rebalancing process where we look at every client portfolio for each specific situation, cash in, cash out, tax situation, and try and align those to what you and your team are coming out as sort of what best in class looks like for each portfolio construction. That very detailed dynamic process we've just gone through. And some clients will have noticed that there have been some changes in the portfolio. Mm-hmm. One of the changes is taking one fund that looks very similar and moving it into another fund that looks very similar. And they may not really fully understand what that's about, but that's sort of about this whole mutual funds versus ETF thing. So let's explain what each of those are and let's talk about why that change is happening.
Well, yeah, absolutely. And if I get a bit geeky on this, you just rein me in and stop me, okay?
I'll throw the flag. Yeah.
But so mutual funds, I think everyone's familiar with what they're about. ETFs are exchange traded funds. And what they are is it's a kind of way of packaging a product. Instead of having it as a mutual fund, it's actually packaged in a way that it looks like a company, a stock price, right? So you have your mutual fund that prices once a day. With an ETF, that trades like a company. So you can have a mutual fund that invests in the S&P 500, say, or you can have an ETF which will invest in the S&P 500. That's priced all day long. So you could get in at a better price than someone else, depending on how the movements. With mutual fund, you're getting in at the same time.
That's one thing I think clients never saw. They never saw that you could only get in the mutual fund at the end of each day, right? They never would have seen that unless they were investing on their own. So they would just see the price at the end of the day or the month or the quarter, and that looks the same. So they would have no awareness that a mutual fund isn't trading all day long, that it's priced once a day at the end of the day, and the ETF is tradable all day long. Why is that difference important?
The benefits of ETFs versus mutual fund is that it's trading all day, so it's pricing all day. It's think of it like a stock, any equity that you're buying in the marketplace, right? You can buy it and sell it at any point during operating hours. Mutual fund is different. You only get that one time to buy or sell it during the day. So there are differences from that perspective. But in terms of exposure, you now have ETFs that cover all kinds, right? You can get the S&P 500 as an ETF. You can get thematic ETFs. Yeah. You can get almost anything you can think of. There are thousands of ETFs.
That is a big change there, right? I mean, I remember when we started, there were no mutual funds.
That's right.
We saw the birth of mutual funds. Then they took off like mad everywhere. Right. And then this ETF thing was created. And there does still seem to be a big proliferation of them.
And it used to be passive. Do you remember?
Yes, exactly. Yeah.
And nowadays it's changing. It's becoming active funds. So active funds.
That's a big change.
That's a pretty big change. They're moving out of mutual funds into the ETF because the ETF structure makes so much sense. Even the sort of active managers are moving into ETFs, which is really a big change. It's a very big change. And the reasons are, the market, the attraction of ETFs for retail investors are immense.
Yeah.
The costs, the expense ratio of getting into these is far lower than for mutual funds by and large.
I think that's the one thing that clients notice. That's the one thing they see is that for someone suddenly seeing going through a review process and was looking at their account and they say, oh, this has come down a little bit. That's the one piece they do sort of notice.
So when we're moving out of a mutual fund into something similar, that's an ETF, they'll notice that the fees, the costs are coming down. Exactly. Yeah. So that's a benefit. But another benefit is the actual costs of trading is a lot lower. But in general, for our clients in particular who are very tax aware, they should know that ETFs can represent a particularly attractive way of investing over mutual funds. So, you know this, the ETFs they don't have the same capital gains. So I guess a mutual fund at year end, if it's made capital gains, they have to distribute those gains out. So there's a taxable charge.
And that can be significant sometimes at the end of the year. Yeah.
And with ETFs, we don't have that, do we? They don't have the same chargeable gain,
right?
And that's to do with the dynamics, the mechanics of how an ETF is structured. And I'm not going to go into all that because
I don't think you need to. I think the fact that it's there is what's important, and I think clients don't often get to see everything that we're all doing under the hood, but in particular your team with investments, and that's one of the really subtle things that, you look at your portfolio, it looks like it's essentially the same. The name of this one seems to have changed, but it looks like it's roughly the same. And what they don't recognize is, the improvements that go into that are a direct result of, the day-to-day effort to how do we do this a little bit better? How do we bring costs down? That's an extra hurdle you don't have to overcome to achieve your goals. How do we improve liquidity? How do we improve tax efficiency, and that to me is what we do, right? It's a game of inches and millimeters. It's how do you continue to turn a dial somewhere that just incrementally improves the probability of long-term continued success. And success is not just a bigger pile of money, but more after net to the client.
These things compound over time, right? There's a significant benefit to clients over longer time periods here of these things, but I mean, the tax benefit is really an interesting one, and it's one that we think makes it compelling for our clients. So we're looking where we have the opportunity, we will move from mutual fund into a ETF equivalent. Now, it's a more tax efficient investment vehicle. People still have to pay chargeable gains on the portfolio. So you don't pay lower taxes because you invest in ETF. But within the ETF structure,
that's the key.
Within the ETF, it's a much more tax efficient.
Just to wrap this up,
in general,
when we're looking at client portfolios, of course, we won't make that shift if there's a huge taxable gain to come out of that into the next one. So we have all of these incremental improvements, but if to get to it has a big tax hit to get to something that's roughly the same in the portfolio, of course, we wouldn't do that. So that's part of the role we're doing.
But you wouldn't let me, would you?
I wouldn't.
Be saying my clients aren't going to do that. Right.
But at a portfolio,
those are the conversations that we have. People are probably not aware that when we are making these decisions that we're discussing this, and you're saying, well, what about the clients? What is the impact on the clients? And we're not making these decisions in a vacuum. Yeah.
How far along is this? The last bit is it like halfway through or a quarter way through in terms of the opportunity to shift from mutual funds into ETFs and to add that advantage into portfolios? Is there a lot more to go, or not really there yet, or how far?
We already have a lot of our portfolios. The majority of our portfolios are in ETFs.
Great.
So that's good. But we're continually looking for ways to improve that and talking to providers about what sort of ETF structures they can build for us. So that's an ongoing dialogue. And active managers are starting to do more of that. I mean, I had this conversation with people 20 years ago, and active managers said they didn't want to do it because their fees would be lower. And now they're having to do it. It's extraordinary how the market has evolved.